What is going on, traders? I promised to make this video worth your while. I want to do this video to help you guys because I know a lot of people are panicking right now. So in my view, this will be the most important video that we make in 2022. And I'm not saying this to toot my own horn, but there are a lot of things coming up in the next week as of the time of this recording that are going to affect the rest of the year. You definitely want to pay attention to this if you care about your money and your portfolio and building wealth over time. So let us get right into it. All right, first of all, what is going on in the market? And then I'll get into the events that are going to touch the markets heavily, as I said, in the coming week. This includes earnings from Tesla, Apple, Microsoft, as well as the FOMC, aka the Fed meetings. So what is going on with the markets? Real quick, this is the worst start to a year since the dot-com crash in the year 2000. The S&P is almost down 9%, and the NASDAQ is already in official correction territory. And a lot of this is due to the fact that they contain the most mega cap tech heavy stocks, down almost 13%. I'm not going to get into specifically how to hedge your portfolio. That will likely be in the next video, but we have been hedging our portfolios heavily this year. And if you want access to all of our trades, link is in the description below. So with that said, should you be panicking? When is the blood going to be over? When is the market going to find a bottom? Let us get into all of this. Well, let's start off with quelling your fears a little bit, okay? Bear markets are very normal. This is an article from Hartford Funds, and although this information is known, it's collected here in a very concise fashion. These are 10 excellent tips regarding bear markets. I will leave this link in the description, but bear markets are very normal. There have been 26 bear markets in the S&P since 1928. There's also been 27 bull markets, but they are not the same thing, even though there has been almost an equal number of bear and bull markets. Bear markets are very short-lived. The average length of a bear market is 289 days, or about 9.6 months, significantly shorter than the average length of a bull market, which goes for 2.7 years. Also, and this is one of the most important things when people are telling you to stay the course regarding your investments, half of the S&P 500 index's strongest days in the last 20 years occurred during bear markets. How is that? Well, because the recovery from a bottom is the most violent rally, or the most violent part of the rally usually. Now, you guys know my channel. This doesn't mean that if you hold high beta stocks, which is a term that unfortunately not a lot of stock YouTubers use because they probably don't know the concept, but high beta stocks, meaning that compared to the S&P 500, they are very risky. Obviously, here we're talking about Skills, Fubo TV, DraftKings, etc. Those stocks, if your portfolio consists of those, in my view, this is the time to reshift, refocus, and start reallocating your portfolio into more blue chip stocks that do well over the course of decades. All right, here's some more information regarding bear markets and why you should stay the course, in my opinion. The difficulties of trying to time the market. Obviously, here we're not talking about options plays. We're just talking about stock investing. Missing what are called the 10 best days in the markets is very detrimental, okay? If you miss the 10 best days every decade since 1930, your return on the S&P 500 would be 28%. That's it. In almost 100 years, your return will be 28%. We're talking about what, 92 years. If you just stayed the course, your return would be almost 18,000%. You don't even have to look back that far. If you look at 2020, right? The S&P, including the Rona March 2020 crash, returned 18%, which is extremely respectable, obviously. However, if you missed just the 10 best days, just 10 days, your return would have been minus 33%, meaning you would have been in the hole 33%. Same thing if you go back to 2010. Price return on the S&P 500 for that decade, 190%. If you missed just 10 days in that decade, your return is cut in half. All right, now let's look at what happens in the NASDAQ after it suffers from a correction. This is going all the way back to 2007. Usually we end up in the green 3 months after the correction happens, right? There have been times 2007, 2008, obviously, that was an anomaly because we had a lot of banks that were going under. Lehman Brothers went under. There was the mortgage crisis, the housing crisis. Anyway, the point is that that was obviously a rare event. And I know that a lot of you are going to be in the comment section saying, yeah, but the Fed printing money, this is rare too. The Fed has never had so much control. And you would actually be right. You would find no quarrel with me. However, let's look back at 2008. This is a blip on the the radar. If you look at a 12-month chart, you can barely detect where the hell 2008 was on this chart. Now, again, this is not to excuse bad investment decisions. Again, in my view, you would use this time to start looking at portfolio distribution, start rebalancing your portfolio. We're going to get some major discounts on stocks that people have been crying to own at cheaper prices, right? If you want your portfolio to look more quality, where the bulk of your portfolio is weighted in blue chip companies and indexes, where you're not over 10% on any single allocation, where you keep the risky stuff at a very small fraction of the pie, literally, the time is coming up. So definitely keep your ears perked up and your eyes wide open for this. All right, so when is the bloodshed going to end? In my view, this type of selling pressure is not without consequence. Obviously, the S&P 500 has not hit correction territory since the March 2020 crash. The NASDAQ is the only index, the only major index that hit correction territory, meaning a drop of 10% or more, but less than 20%. Right now, the S&P 500 is at almost 9%. I think obviously we get that 10% drop. It might even drop to the 300-day moving average at around, over 12%. But I'm not really concerned with this as I am about the cycle of corrections. What do I mean by this? Okay, well, how do corrections normally happen? Well, you get this insane buying pressure that leads to a trend line. And even though we've had obviously ups and downs, the major trend, you can almost draw a straight line through the trend of the S&P 500. That was a hella sloppy job, but you get the picture. So what happens is the bulls get exhausted, right? These companies are valued heavily, multiple times earnings, multiple times sales, etc. And now the market is like, okay, I want you guys to prove, I want these companies, the market is saying, I want these companies to prove their valuations, meaning they have to grow into their valuations. But at some point, obviously not, things can't just move up linearly forever. And at some point, their earnings are going to miss. This brings me to Netflix, right? We'll talk about Netflix in a second. But usually you get this buying pressure in a rally, right? And we get this nice uptrend. However, bulls get exhausted and we start getting selling pressure. Now, once we cross into that 10% and below, things get crazy. And now what we're looking for after that selling pressure, right? This is called a sell-off. We're looking for capitulation, meaning when do the bears finally give up? Everyone is panic selling. And just like the bulls get exhausted here, we're looking for the bears to get exhausted, meaning the ones who are going to give up have already given up. And now the market is just silent. One of the ways that we can determine this is looking at the VIX futures. Now, the VIX is the volatility index, basically the market's fear gauge. It is based on volatility in the SPX futures or the S&P 500 futures. Now, one interesting thing that I found through reading and watching other videos, sorry, I can't credit the exact person who actually pinpointed me to this. However, this is not a unique theme. This is something that's been talked about over and over again. But if you look at the VIX 3-month versus the VIX front month, meaning the current month's futures contract, that ratio, when the current VIX contract, the VIX futures contract that expires the soonest, is more volatile than the one that expires in 3 months, that is when we tend to see market bottoms. And when in TradingView, you go VIX 3M divided by VIX, like you see here in this symbol, this is basically a ratio. So when this ratio falls below 1, that means the current month contract is actually more volatile than the one that expires in 3 months. And if you don't believe me, look at this here. When the ratio is below 1 and we see a bottom like we did here back in March 2020, that's when the capitulation basically is over. That's when the bears have all given up, and now it is time for the bulls to take back over. Now, obviously, you cannot predict this bottom, meaning like you can't look at it and say, oh yeah, this is, as a matter of fact, the time that the market has bottomed out. But when you start to see it go below 1 and then there is a bounce from there, then along with other indicators, you can use this as a way of potentially telling when the bloodshed will be over. Now, I'm not saying time the market. I'm just telling you things to watch out for if you are curious about this stuff. One other thing regarding the VIX, if you just take a look at the VIX itself, right? If you, screw the ratio, let's just take a look at the VIX itself. Usually when we see a correction to a bear market in the S&P 500, the VIX is spiking above 30, sometimes even 40, which is very rare. Right now, the VIX is currently at around 29. However, what you're looking for in the VIX to S&P 500 relationship is you are looking for when the S&P 500 is, basically in correction territory. You're looking for the VIX to start dropping as the market is finding support. So what do I mean here? Let's go back to the most recent correction / bear market in the S&P 500, and this was the March 2020 crash. If you see here, the VIX spiked to 80 something, right? Which is absolutely insane because this was the fastest bear market in stock market history. However, around the time that the stimulus bill was passed, this was around March, the week of March 20th, March 23rd, somewhere around there, you start to see the VIX actually falling violently from that top, right? And this coincides with the market created a bottom. This coincides with the market finding support here. So what you want to, we're not there yet. We're not anywhere near there yet. If you look at the VIX now, the VIX actually looks like it's going up. So what you want to see is you want to see the VIX start to fall as the market is creating a bottom, right? Or is finding support. So if the market does something like this, goes to the 300-day moving average and starts finding support, and let's just say the VIX spikes a little above 30, once the VIX starts falling at the same time that the market is creating the sort of moving sideways, then you know that it is likely time that the bulls are coming in ready to support the market. Again, please don't misconstrue this. I'm not saying time the market, stuff for you to look out for. All right, so the most important things that are going on this week besides these levels that you need to watch. Number one is going to be earnings. We have Apple, Microsoft, Tesla reporting earnings this week. We also have the FOMC meeting. This is the official Fed policy. So when are the dates for all this stuff? Let's take a look at this. We have Microsoft reporting after close on Tuesday, January 25th. We have Intel and Tesla reporting after close on Wednesday, January 26th. We have Apple reporting after close on Thursday, January 27th. This is super important because of how the market reacted to Netflix. Remember, Netflix is a FANG stock. It is in the coveted FANG category, right? It is one of the bigwigs. It is one of the blue chip tech / innovation stocks. And Netflix, basically, they did beat on earnings. They slightly missed on revenue. They still had a $7.7 billion quarter, but they said, guess what, guys? Now we have potentially suffocated the subscriber growth has stifled, and we don't really see in the near future a way of significantly increasing subscriber growth. Now, obviously, these companies are really good at innovating. Obviously, they have the video game thing going for them. So I have no doubt that they're going to start entering different business verticals. There's obviously some BS probably related to the metaverse in some way, watching movies in the metaverse. I don't know. Maybe they'll buy Pornhub. Who knows? All I'm saying is that this is a precursor, right? Like if FANG stocks are not immune to a violent drop of 22% in one day where Netflix was trading above 500 and then all of a sudden it finds itself trading at 380 something. If Netflix is not immune to that, then don't think that Apple, Tesla, or Microsoft will get the same treatment if they miss. Now, very different business model, I know, but still something to watch out for because really what I'm watching out for is opportunity here. I really want to see if we can get a major discount on Apple and Microsoft. Tesla is the one I think that is the biggest open question because it is, I think, the highest beta of all of the mega cap stocks. And also the one that recently doubled in price within a couple of months and the one that has the most to prove, right? So people are going to want to hear about the Cybertruck. They're going to want to hear about sales and factories in other countries and updates on some products that have been in the pipeline. And they're going to want to hear about cash flows and profit margins. So this is one that I'll be watching intently, even more so than Apple and Microsoft, in my opinion. The good news is that after Tesla, Apple, and Microsoft report, if the earnings are not horrible and guidance is actually in line with what the market predicts, those stocks have the ability to uphold the market and really enforce an exuberance in the market, right? Like reinforce an exuberance in the market and potentially find a bottom to this correction. This brings me to the last topic that we'll discuss today, and that is the FOMC meeting, January 25th and 26th. Set your alarms, set your clocks. Make sure that you remember these two dates. This is when the FOMC, aka the Fed, is going to dictate official policy. Are we going to get 3 rate hikes? Are we going to get 4, maybe more than 4? What is the federal funds rate goal for the end of the year? Are they going to start selling assets off the balance sheet, or are they going to let them roll off? Sort of like Jay Powell was using wordplay there during his second term confirmation, saying that, no, we're actually not going to sell assets off the balance sheet. We're just going to let them expire. Who knows, right? Everything will be dictated based off that. And obviously, they're going to be taking the S&P, what's been going on in the stock market. They're going to be taking that into account. Everything right now is conjecture until Jay Powell opens his mouth and tells you what the Fed policy is going to be. And that's going to set the tone for 2022. That's going to set the tone for rate hikes. That's going to set the tone for treasuries. That's going to set the tone for yields, obviously, for stocks. That's going to set the tone for earnings and growth stocks and mega cap stocks, etc. It's going to be, in my view, the most important week for 2022 is coming up in January right now, the week after the time of this recording. Anyway, traders, I hope you got something out of this video. If you did, leave it a thumbs up. If you want to learn how to hedge, set up your portfolios, you want to talk trades, investments, etc., come join our group, 4,000 traders. Very zealous, helpful community, talking all day, every day, helping each other out. It's a great value, in my opinion. Come be a part of the community. Let me know in the comment section below what you think. Are we going to hit bear market territory? Not. What are you guys doing with your portfolios, etc.? Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.